Okay, so again, the question was, what does the 113,591 mean? What we're saying here is that if we were to go out and buy a bond, if we were an investor and we wanted to buy a bond with a $100,000 face value with a 10% stated interest rate, right, the amount in the contract, they're going to pay me 10%, when the market interest rate that we're demanding a return on our investment is only 8, I'm going to pay more than face value for it. Okay? So that I get the higher return. I get that 10% return. And it all comes down to this. I'm getting a payment of $5,000. If, and I'm going to do this right next to the other one, if my principal times rate times time, my principal is 100,000, and my interest rate for my semi-annual payments was only 4%, right? Because that's 8 divided by 2. 100,000 times 4, my payments would only be $4,000. So I'm getting more cash paid to me because the stated rate is higher than what I'm willing to accept. I'm willing to accept 8. And because the payments are higher, you use the present value, it becomes a bigger number. Okay? If I took 4,000 and plugged it in here, times that, and then this, you'd get 100,000. But what you would be doing is forcing the stated rate and the market rate to be the same. Okay? So I'm offering you more money. An analogy. Okay? If I give you $100 today, I want you to give me $5 a week for the next 26 weeks, half a year. Okay? I'm making a little interest on that, right? Okay. You might be willing to do that. If I give you if you say, no, I'm willing to pay you $10 a week instead of $5 for the next 26 weeks, I'm willing to lend you more money all of a sudden, right? And that's all that's going on here. I'm willing to lend you more money. Okay? And that's a non-mathematical way to look at it. Yes?
So is that also by taking the higher payment, is that also an investor's way of making a profit off a bond that they're actually paying more on?
I want to dive into that. I want to do an amortization table of the bond and show you that you end up making 8% on your money anyway, because you paid more for it. If you paid less for it, you would make a higher interest rate. Okay? The less you pay for it, the higher your return is on your investment. The more you pay for it, the lower your return is. Okay? Good? Yes?
I have a question on the payments, on the calculation you did to the right. So what that is what the payments are worth at the end of the 10 years?
No, present value. Okay? We're getting, remember, in blue, we're getting 5,000 6 months from today, 5,000 12 months from today, 5,000 18 months, 5,000 24 months, and so on. And if you calculate what all those are worth today at the market interest rate, 8%, they're worth $67,000. All right? And then you add that to what's the $100,000 payment 10 years from now worth at 8% interest. You know, again, what would I have to put in a savings account at 8% interest today to get me $100,000 in 10 years? It's $45,000, and it would grow over time. So if you put in $45,000 today, it would grow over time to hit $100,000. Okay? That's all we're doing is figuring out what that amount is that we have to put in. Okay? Other questions? Okay, so let's walk through amortization of one of these just to kind of show you how it works. And again, what's driving this is the fact that the stated interest rate pays you a fixed amount of cash. So I'm going to put in a date here, but I'm just going to call it year 1, 2, 3, 4, and so on, okay? Because it's a 10-year loan. We have an interest expense. We're going to have an amortization. Remember we talked about depreciation, and then amortization was something you did for intangible assets, right? Where you expense its value over its useful life, okay? And then I'm going to have balance of amortization. And then I'm going to have the book value of the bond. Oh, another term I want to throw at you before we go anywhere. Over here, where we paid more for the bond than the face value, $100,000 face value, we paid $113,000 for the bond. That extra $13,000 is what's called a bond premium. And remember, on the other side, when the interest rate was 12%, we only paid $88,000 for the bond. That $12,000 shortfall compared to face value is called the bond discount. Okay? We'll do one of each here. So in year 0, I need to back up just a little bit more. Let's take our bond premium, the one where we paid $113 for it, okay? How would we record that if we were the company, if we're IBM and we sold those bonds? How would we record it? What's the one thing we got? We got cash, right? So we're going to have a debit to cash. How much cash did we get?
$113,000.
There's the answer. We got $113,591. Because that's what people paid for those bonds. Good? Okay. How much is our bonds payable? $100,000. In 10 years, all we have to pay is $100,000. So that's our liability on our books. Am I in balance?
No.
Do I have a problem?
Yeah.
Okay, where's the rest of it go? Bond premium. $13,591. Okay, think about it like it's a regular bank loan. I borrowed money from the bank today. That's how much I'd have to pay them off if I paid them today. Okay? 10 years from now, this is going to go away, and all I'm going to have to pay them is $100,000. There's the hard concept, and I'm going to show you why. Good? Everybody understand the entry to book this? Okay. So at the beginning, the book value of our bonds is how much? 113. $113,591. Okay? What is our interest that we have to pay on these bonds? It's $100,000 times 10% is our stated value, remember? Times 6 over 12, because they're paid semi-annual. This is $5,000. Everyone agrees. So our interest, I need one more column. I know, I'm sorry. I'm going to squeeze it in. Cash payment. So I have cash payment, interest expense, amortization, balance of amortization, book value. Okay? So at the beginning, my premium is $13,591
So that's year zero?
in year 0. Okay? My book value, therefore, is the $100,000 plus the unamortized bond premium. How much is my cash payment in every year? $5,000. I'm sorry, every semi-annual payment. Remember, there's 2 per year. So this goes all the way down to payment 20. Good. Each one of these is $5,000. And so on. Okay? Everybody follows me. There's 2 ways to calculate interest expense. We're going to do the easy one. Okay? And to do that, we're going to take the $13,591, take your amortization, divided by the number of periods. So I've got 13,591 divided by 20. Anybody?
679.
679. We're just going to call it 6. Let's just call it 680 because we'll do some rounding. 679.55 is 680. So my amortization in every period, in all 20 periods, is $680. Good? And we all agree that that will eat up the 13,591 over time.
So every month you're going to lower the price.
Yes. So for example, what's 13,591 minus 680? $12,911. 12,911 minus 680?
12,231.
12,231. That minus 680?
11,551.
5 what?
551.
551 minus 680.
10,871.
And in this last 20th period, I'm going to tell you it's going to be 0, right?
Better be.
When we use it all up. So my interest expense,
Well,
go ahead.
question. Since we're kind of rounding up, since we're rounding, it's not...
It's not going to work out exactly because I rounded, okay? If we had a computer and we were doing this accurately, I would have gone with 679.55 and it would come to 0. Okay? For writing on the board, we're rounding. Okay. Other questions? Okay. So my interest expense, I'm going to send out $5,000 in cash. IBM, I'm going to send these people $5,000 every 6 months, right? But my interest expense, because they paid a premium, is actually what? Is it more or is it less?
It's less. Because
Your
you're...
expense more because it's more money.
What?
You have to expense more because it's
Because
more
I
money.
borrowed more money. Okay? So my interest expense is $5,680. Okay? I'm going to come back over here. And I'm just going to walk through this. Here's where we issued the bonds. We got $13,591 in cash. Now, when we make the interest payments, what are we giving up? So cash is going away to the tune of $5,000, right? Our interest expense is what? Which means I need another credit. A credit will only do what to this bond premium? It'll make it go up. because it's a credit balance. So Eric was actually right when he said this serves to decrease our interest expense. 5,000 minus 680 is 4,320. Is that correct? Okay. So I did this on purpose because I want to show you the mechanics of it. Our interest expense is 4,320, and our bond premium now gets a debit for that 680. Okay? If I debit my bond for 680, my bond premium for 680, the balance comes down, and that's what I'm showing is going on here. This balance is going down over time. Yes? Everybody good with that? So that's the entry we make every 6 months. Cash is going bye-bye. Our interest expense is actually less. And logically, that's true because they gave us the cash to give back to them for the interest. So we actually have less expense because they gave us the money to do it, right? So let me just kind of work through this. My book value goes from $113,591 to $112,911 to $112,231 to $111,551, $110,870 down to $100,000 when we're all done. Right? The balance just works its way down to that $100,000 when we use up all of the premium. Good? Everybody follows me? Yes, ma'am.
So the interest expense stays the same every period?
The interest expense will be that $4,320
All the way down?
every period. Okay? Now, when we're all done, 10 years in the future, we've made these 20 payments, our book value is $100,000. What's our entry to pay off this loan? Debit to?
Bonds payable, 100,000. Credit to cash payable, cash, 100,000.
Cash goes out. 100,000 bucks. Good? So once I've made this entry and I've made all of these entries, my bond premium balance is what? Zero. And my bond payable balance becomes what? Well, after I make the payment, though, it becomes what? Zero. So they both go away. Over time, I have less interest expense because they paid more for the bond.
So once the bond premium goes away, then the interest expense will go down?
The bond premium exists the entire life of the bond until you get to the end, and that last payment uses the last part of it. Okay? So if you were to calculate your interest expense over that whole period of time at 43.20, what's my interest rate? Is it going to be 10%?
8%.
At 10%, my interest expense would have been $5,000. At less than 10%, my interest would be $43.20. So I'm paying less than 10% right out of the gate, and I'll tell you right now, it's 8%. So whatever that market interest rate was is what turns out to be our borrowing cost on all this money.
So it just looks like we're getting more.
They paid more to get the higher cash flow, but they're only earning 8% and we're only paying 8% because that's what the market rate is. Good?
Now, does it really always work out like that? Or?
Always. This is like debits and credits. If they don't balance, you got a problem sort of thing. Okay? Questions? All right. So let me throw one more thing at you. When I came over here and I calculated my interest expense being the same for the entire life of the loan, this is the straight line method of doing this. We've calculated the same amortization over every period. Okay? That's one way to do it. There is another way to do it. There's always two, right? The other method is called effective interest. And the effective interest method is based on the balance outstanding, and you calculate the interest based off of this every time. So you'd get a different interest expense, and you calculate a different amortization.
This would be like double declining.
It's like double declining, okay? Remember when we did the table to calculate double declining? I'm going to do it here just to show you, but I want to explain what the thought process is. Okay? Are we good?
What would be the purpose of that? How would that make it better or worse?
It is more accurate because it reflects what you've got going on here. It reflects your true cost of borrowing whatever amount of money. Okay? Questions?
So, when you're looking at the market rate, it stays the same for the whole bond, or does it change before the bond is paid?
I want to make sure I understand the question. The stated rate on the bond never changes.
Right.
It is what it is because it's in writing. The market rate is determined at the sale date,
And
the
then-
initial sale date,
And it stays the same for the whole,
for the whole
For the
life
books?
of it. For IBM, the company's books, it stays the same from that point through the entire life of the bond. Okay? If I'm the investor, though, and I go out and I hold the bond for 3 years and I go and sell it, the new investor is going to base his investment off of that day's market rate. Good? Okay. Okay, so back to the slides. If the bonds sell at par, the entry on the books for Burlington Northern, they get $100,000 in cash. They have a note payable for $100,000. Sorry, bonds payable for $100,000. Asset liability. The periodic payments every 6 months. Interest expense $5,000. Cash goes down $5,000. When they're all said and done, you know, debit bonds payable, credit cash for $100,000. That's if stated value and market rate, stated rate and market rate are the same, which never happens, right? Okay. So there's the theory, if they're ever the same. For our projects, since we talked about that, and the next additional thing for the project is the ratio analysis that you're going to turn in next week. Times interest earned is a new one. This is something that lenders look at in making a loan decision. What you're doing is you're calculating how easy it is for the company to make the interest payments on the debt. So net income, add back interest expense and income tax expense, right? Take that out. So you're converting back towards a cash kind of activity. Divide it by the interest expense, and you end up with a number. And this may say that, you know, they generate enough income to pay the interest on the debt 2.5 times, 10.5 times, 60 times, whatever the number is. The higher the number, the easier it is for somebody to make the interest payments on the debt. Bless you. So the higher the number is, the more likely the lender is to let you have the money. Good? Okay. All right. Bonds at a discount. Here's where we stated interest rate of 10%. The market rate is 12. So are we going to pay the whole $100,000 for those? No, we did the math and we came up with $88,000 and change, right? Okay. I'm just going to walk through it real quick. You look up the factor based on semi-annual rate of 6%. You can remember to modify the interest rate to whatever your time period is. annual, semi-annual, quarterly, monthly, whatever it is, you've got to modify it or you'll get the wrong answer. So the current value, present value of the payment of $100,000 10 years in the future, it's worth $31,000 today. The present value of the annuity of payments of $5,000 is worth $57,000 today. Buyers should pay $88,000 for that bond. That's the number we came up with, by the way, right? Hey, we did something right. Okay? So there's a discount of $11,470. We didn't do an entry on the board for a discount, but in that case, notice that your credit to bonds payable is still $100,000. You only got $88,000 in cash, so you get this debit discount on bonds payable of $11,470. Okay? And that's what makes it balance. Here's what I wanted to show you. I should have thrown this on the board too. Balance sheet presentation. Long-term liabilities. You show the bond payable for the full face amount, the $100,000. And then you show the less bond discount to show the net value of $88,530. In the case of a premium, you would say plus bond premium, $13,591, and you would add it and show the $113,000 number here. Everybody good with that? So, you know, again, a little bit more detail on the presentation. There are two methods for amortizing the premium or discount: straight line, which I showed you on the board, and effective interest, which we're going to do. Straight line is simple. I took the total amount of the premium divided by the number of interest periods, and I used that to modify my interest expense to bring the balance to zero, right? Piece of cake, really straightforward. They're using the discount, so their numbers are different, but they take the $11,470 discount divided by 20 periods, $574 a semi-annual period, right? And here we go with the interest. Interest expense in this case goes up. Remember what ours with the bond premium, the interest went down. Here with the bond discount, your interest goes up so that you have the credit over here to reduce your bond discount, which was a debit. Remember that? So notice how it works. And then as time goes on, the discount goes down and your bond value, book value of the bond goes up on your books. When you get to the end, the bond is worth $100,000. You pay $100,000 in cash. It goes to zero. Everybody's good. Yes? So it works the same way as the premium that we did on the board, but it's just slightly different. Go. Okay. Here's the year's interest payment. They calculated the discount. They added it to the interest expense, dropped the amortized balance down to zero. Balance of the bond comes up to $100,000 over time. Really straightforward, yes? This is now rehashing the same stuff, right? Good? Catherine? Yes? Okay. Effective interest rate, we compute the interest expense by taking the unpaid balance and multiplying it by the market interest rate, okay? We calculate the cash payment, always the cash payment from the stated interest rate, but the expense is calculated from the market interest rate, okay? And then instead of calculating the interest expense, we calculate the amortization by taking the interest expense and subtracting the cash. Got it? Okay. So we're going to do the same thing, but now we're going to do it with the effective interest method. So in this example, I want to go right to the table. We're going to take the book value of $88,530 and we're going to multiply that times the market interest rate, which was how much? 12%, correct? 12% gives us 5312. 5,000 is still the payment because that's calculated off of the face rate, the stated rate. The difference, 5312 minus 5,000, gives us 312 for amortization. So your discount goes down by 312. And your book value goes up. So as you can see, as your book value goes up, your interest expense actually is going up. And you're chewing up, you're amortizing your discount faster towards the end. Good? Let's go back. Yeah, we did that. So the entry, interest expense, is the amount we calculated, 5312. Credit to the bonds payable, discount of $312. Cash goes away, $5,000. Good? Really straightforward. I like this. Okay. Now here's something. Let's come over and look at this. In our example so far, we've got a $100,000 bond that pays interest every 6 months. So we've got this annuity of payments of $5,000, right? There's something out there called a zero coupon bond or a deep discount bond. Same thing. And in a zero coupon bond, there is no annuity of payments. There is no stream of payments. It is, I borrow the money from you now, I will pay you one lump sum at the back end. Okay? Now, if we were to treat this that way, and our bond was a zero coupon bond of $100,000 for 10 years at 8%, what's it worth? It's worth $45,640, right? Because you're only calculating the present value of that one payment. You don't have the annuity of payments adding to its value anymore. So that's why it's called a deep discount, because I'm going to pay you $45,000 for that promise to pay me $100,000 6 years or 10 years from now. Again, the real question there is, if you had to put money in a bank account today at 8% interest to generate $100,000 10 years from now, how much would it be? $45,000. Okay? So the only difference is you don't have the stream of payments. It makes the calculation really easy. You have to do half as much work. Questions? Just to work through another example, bonds, if they're issued at a premium, we did the discount here. This is the problem that we did over here. We did present value of that $100,000 at 8%, but it's semi-annual, so we used 4 in the table in 20 periods. The present value of that $100,000 payment was $45,640. And the present value of the other payments was the $67,951. This is our problem that we did. So that bond was worth $113,592. A little rounding going on there. We're off by $1. All right, close enough, right? We went through that. Here's the same table. This is the straight line amortization, just like we did, 680. Right? And the effective interest rate, you take the 113,592 times the market interest rate, which was 8%. It's less than the interest payment, so we're amortizing the premium. And as time goes on, you end up amortizing more until you finally drive the balance of the premium to zero and the book value to $100,000. Good? Straightforward? Good. Everybody likes these? We should see one of these on a test then, right? They're fun.
Is that a hint?
You'd think. Yes. All right, one more ratio, one more analytical. Debt to equity. We've been talking about a lot about debt in different types, right? Whether it's going out and issuing equity, or i.e. borrowing through selling stock, or borrowing from a bank or borrowing through bonds. A good thing to know about your company is, what does its capital structure look like? Does it borrow most of its money, or does it get most of its money from its shareholders? And there's an element of risk there. Remember, if you borrow money from the shareholders, what happens if you have a bad year? You don't declare a dividend, you keep the cash. If you financed your company mostly through borrowing from a bank and you have a bad year, what do you have? I have a cash flow problem, right? Perhaps. Because you still have that interest expense and you have to make those interest payments. Good? So if you take your total liabilities and divide by stockholders' equity, you get a ratio. And if you borrow most of your money from banks, this number will be bigger than 1. If it's much smaller than 1, you're borrowing most of your money from stockholders. Okay? And you got to weigh the risk. There's risk involved with either side of that. Good? So there's another fun ratio. Ratios are fun, right?
And that includes all the liabilities.
Total liabilities. Okay? Total. All right. Remember I talked about in the beginning with the bonds, some of the bonds are what are called callable. Yep. The company may say, okay, it's been 5 years, we got a bunch of cash, let's pay these off so we don't have to pay the rest of the interest expense. If that happens, if the company calls the bonds, what you do at that point is you calculate a gain or loss. At that point in time, the company does. And they record the gain or loss, and then they pay off the balance of the note. So when you have note, it's a bond, not a note, bond. Typically in the bond contract, in the language, over here. In the language, it'll say, if I call these bonds, I'm going to pay you a premium. And if the company pays you a premium, you weigh it against the bond premium or discount that already exists on your books and calculate a gain or loss. Okay? Another thing that I want to talk about, if the book value is greater than the retirement price, you have a gain, right? So if I've got a $113,000 book value and I only have to pay off $105,000, I've made some money. If my book value is $88,000 and I have to pay off $105,000, I'm probably not going to call the bonds, right? Okay. When bonds are bought and sold, they trade at, and you'll hear this on the news or if you look up bonds, the bonds were trading at 105. It's this calculation here. If we have a $100,000 bond and it were to sell for $105,000, the bonds are selling at 105 or 105% of face value. If the bonds are selling at a discount, they're selling at 95 or 98. Or in our case, they're selling at 88, remember? You'll hear these words, these phrases. So in the bond market today, bonds are selling at 102, means people are paying a premium for whatever that stated interest rate was. Okay? You need to know the stated interest rate to make sense of what that 102 or 88 number means, but you will hear that term. Questions? Yes, ma'am.
Are we going to have to do a calculation for an early retirement?
I haven't gone over it yet. We might in the homework, but I don't remember if we do or don't. So let's not worry about it at the moment, okay? All right, other questions? Okay. We're getting close to the cash flow chapter, so I want to hit on that a little bit. Remember what we've been talking about. All of these forms of borrowing, whether it be through equity, from a bank, from bonds, they're a form of financing for the company, right? That's where I started the lecture tonight. So if I issue bonds, I'm getting what? Cash. Cash is coming into my company. I've got an increase in cash flow. If I pay off the bonds, cash is going out. I've got a cash outflow. So if I pay off the debt early, it's an outflow. When I pay them off at the end, it's an outflow. So that cash flowing into me from borrowing money, or cash flowing out for paying off the debt, is a financing activity. What I do want you to remember, though, there's a small tweak. The interest expense is an operating item in cash flow. Where does it show up on the income statement? Where does interest expense show up on the income statement? After operating income. It goes in other income and expense, right? On a cash flow statement, it is part of your operating activities, right? Because it's from the income statement of your company. But the cash flow is part of you running the company, so it's an operating activity. It's not a financing activity like the borrowing of the money or paying it back. Okay? Good? I'm going to skip that. I'm going to skip that. Questions? No? Okay, we're good.